Welcome back to the Money and Wealth Show. I'm Sterling Fox in conversation with David Smith, who is a resource sector analyst and contributor to the Morgan Report at silver-investor.com. He also operates a company called The Right Doctor. He's a very busy man. And David, just a few moments ago, we were talking about junior companies, senior companies, where individuals are likely to invest or where they look when they consider investing. I want to talk for a minute about exploration companies in this context. In Canada, the odds of winning the lottery in any game are 29 million to 1. Many people see exploration companies in the mining sector as having about the same chances for success as a $2 lottery ticket. How true is that degree of skepticism?
Well, I think that there's a certain resonance to that analogy. It might not be 29 million to 1, but it's several thousand to 1. And it's something, if a person wants to get involved with exploration companies, I think it should be a small portion of their portfolio.
Okay.
You might get lucky and win outsized gains, but it might go to zero. And these companies can drop 50% in one day for no reason at all. And if they make a discovery, which oftentimes comes out of nowhere, the company can really zoom. And we had a case here earlier in this sector of one company that went from 35 cents to $42 over a period of about a year. And some of those will go up from 35 cents to $9 to 35 cents. So there's a matter of getting some of it out along the way.
So it would be, I would think, the disposable portion of the portfolio, the fun money, if you will, not the serious long-term strategic investment money.
Exactly. You want producers to do the heavy lifting, quality producers that are making a profit, and they will serve you throughout the rest of the cycle in a reliable fashion, and the explorers can be icing on the cake if you really hit it.
All right, let's talk about base metals. We've talked about gold and silver. Let's talk about the other part of the entire metal sector. You're very knowledgeable in this area, so let me just throw out what's hot and what's not these days.
Well, copper's been pretty hot after it dropped down, lost half of its value in 2008 when everything crashed, and then it regained most of that. And so the base metals themselves kind of go in and out of favor in the process of the cycle, but yet the demand for all of them is so substantial that they tend to keep moving forward on an upward basis over the years, So zinc and lead, and the thing is, not many people realize this, but about 60 or 70% of all the silver mined is as a result of mining base metals.
Okay.
There aren't many pure silver producers. So, for example, BHP Billiton, which is one of the world's largest commodity producers, they produce millions of ounces of silver, but that's not even what they're after. They're primarily base metals. So you look at a company like that, and if you're interested in appreciation of silver rather than a lot of base metals, then you would try to find a company that is primarily a producer of silver without a lot of base metal credits.
Again, with the portfolio in mind, David, is it smart, again, long-term, to hold some gold, some silver, and then spread some around across the spectrum of base metals?
I think that's excellent, Sterling. It gives you, rather than being a two-trick pony, you've got the whole sector covered, because there are times when base metals are very, very strong due to economic activity, and they can even outpace gold and silver at that time, even though silver is considered an industrial metal too. And there are other times when the base metals go into the tank and gold and silver are moving forward on their own fundamentals and by market demand. And so if you have both of these covered, you've got some action going on throughout the cycle with one or the group or the other.
All right, let me change gears at you for a moment or two and talk about, of all things, uranium. In the province of Saskatchewan, Canada, uranium, along with a lot of oil, is going to turn that into the next real have province in Canada and a real booming, buoyant economy. What can you tell us about uranium as an investment possibility?
Well, a few years ago, uranium went on quite a boom of its own. It had gone from like $4 a pound, I think, up to $147, $150 a pound, just a massive appreciation. And all these companies came out of the woodwork that were looking for uranium, and they, go up by 10 or 20 times. And then there was a big collapse in uranium prices. It had gotten overpriced, and it dropped down almost to where it started, well, at $25, $30 a pound. But now there's some really compelling case because it's still out of favor, and a lot of people got burned on these companies. And so, but now it looks like it has really good long-term potential because there have been new types of, like the pebble reactors, new types of reactors that have been built that are very safe. There's no chance of a meltdown or terrorists getting in and blowing the thing up or something like this. And it produces an enormous amount of energy for the amount of input that you put for the uranium. And I think that there's a compelling case. It's not going to happen tomorrow, but I think it's going to be a steady appreciation of uranium prices and the quality of uranium companies over the next 5, 10, 15 years. I think it's a very long-term positive uptrending story.
So as one considers the spectrum of energy stocks, natural gas, oil, etc., don't overlook uranium.
That's exactly correct. I think uranium has a place in a diversified resource sector portfolio.
Our guest, David Smith, is a frequent contributor to silver-investor.com, the home of the Morgan Report. Feel free to visit anytime and enjoy the writings of our guest, David Smith. David, it's been a real treat having you on the Money and Wealth Show. Thanks for coming by, driving up from Seattle, Washington to join us. It's been great having you.
I've enjoyed it, Sterling. Thank you very much.
Our pleasure. And we'll be back after this.
Tax Tips with David Ingram.
Charitable giving. If you're going to give money to charity, don't give money, give stock. Let's pretend you bought a stock for $1 and it's worth $10,000 now. Well, if you use Form 1170, T1170 with your tax return and give the charity the actual stock, the shares that are worth $10,000, you've made a $9,999 capital gain, but it's tax-free on Form T1170. The charity gives you a charitable deduction for the whole $10,000. What a good deal, $4,400 tax refund. You don't have to pay any tax on the capital gain. That's a tax tip.
And that's our program for this week. Our thanks to David Ingram and to our special guest, David Smith. Thank you for joining us. If you have some thoughts about today's show that you'd like to share with us, please send them along to comments@themoneyandwealthshow.com. I'm Sterling Fox. See you next time.
Comments made on the preceding paid commercial program are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time.